We talk about this about every day lately, right? Prices on everyday items like groceries, gas for your car, all ticking higher and higher. Well, breaking this afternoon, we learned that interest rates are going up as expected, and that means it's going to cost you more as well to borrow on things like your credit cards, as well as variable rate car and student loans, even future mortgages. So what does that mean for the price we pay? Greg McBridge joins us live right now. He is Chief Financial Analyst with Bankrate.com and a friend of the show. It's great to see you again. The Federal Reserve announcing this afternoon that it's raising its benchmark rate by a 1/4 percentage point or 25 basis points. We'll show our viewers this. The move is meant to help rein in inflation. It's at a 40-year high right now. What does this mean, though? I mean, we hear this, right? And a lot of people kind of have a hard time making sense of it. What are the mechanics of what changes when interest rates go up, and what is ultimately the impact on the average person watching?
Well, the big picture here, Michael, is exactly that. They're trying to rein in inflation, but it's going to take a series of interest rate hikes, not just this year, but also into next year. So I think the significance for the viewer is this. This is the beginning of rates going up for the next 12 to 24 months. And your biggest exposure is going to be on variable rate debts, your credit card, your home equity line of credit. If you have any private student loans, many of those are at a variable rate. Those interest costs are going to go up. So it's not just the future borrowing you do, but with those variable rate debts, even your existing debts can be subject to those higher rates.
So, Greg, this is the first bump in the benchmark rate since the start of the pandemic, when basically interest rates just went straight down, right? We kind of had no choice. We were in the middle of an economic disaster. Nobody really knew what was going to happen. Millions of people are out of work. So this is a change, right? It's a big change compared to where we've been for the past couple of years. What does it signal, though, in terms of the Fed monetary policy and how many of these increases we're going to see? I mean, you said the next 12 to 24 months. I read today possibly 6 of these in a row. What does that add up to at the end?
Yeah, I mean, to start with, we're just reversing the interest rate cuts that they had made at the onset of the pandemic. As you noted, those low rates were a key part of giving the economy a bit of a tailwind for the rebound. Now that we've seen that, and now that inflation has also rebounded, it's time to reverse that. So now the Federal Reserve is going to start raising interest rates, and they're likely to raise them beyond where they had been just prior to the pandemic. The fact is, with inflation at a 40-year high and still accelerating, they may have to get very aggressive. Those 6 additional interest rate hikes that are expected this year, that amounts to about 1.5 percentage points. So there's a cumulative effect to be mindful of here. Cumulative not only in terms of what that does to the household budget and those variable rate debts, but also with that cumulative effect, it's like a stiffer and stiffer headwind for the overall economy and the job market as well. Not a 2022 thing, that's probably more of a 2023 and beyond, but there are long-term ramifications that build over time.
It was so interesting today. I was kind of looking at some of the charts that were on CNBC and other news websites. And when we had really high inflation back in the early 80s, interest rates were up at like 18, 19%. So we're still very historically low interest rates, right? And dealing nothing with like we had back then. But you touched on what this kind of means for the average person watching in terms of their loans right now with variable rate loans. But what does it mean for us in terms of the rest of our lives and sort of the impact that this is supposed to have on the economy? I mean, how quickly do we think this can help deal with inflation? And what does it mean in terms of the other kind of ripple effects throughout the economy, you think?
Yeah, these interest rate increases, they act with a lag. So the impact of the single 1/4 point rate hike today, pretty inconsequential on the household budget. But a succession of interest rate hikes, that cumulative effect will build. And over time, that's what will temper demand in the economy and hopefully take the edge off of inflation. Now, unlike cycles past where rising interest rates were very effective at bringing inflation down, it's not going to be a panacea this time because of the supply chain issues that we see, because of the commodity price pressures coming from the war in Ukraine. So the Federal Reserve, they're going to have to get very aggressive in raising interest rates, but even then, they're not likely to solve the inflation puzzle on their own.
Yeah, I've got less than 30 seconds left, Greg, but do you see anything out there that suggests that the other problems, the supply chain issues that are causing inflation, that those are improving at all?
No, in fact, with the Omicron and causing factory shutdowns in China just this week, that's the next ripple of supply chain issues that'll literally work their way across the Pacific in the months ahead.
Greg McBride is Chief Financial Analyst with Bankrate.com. We always appreciate your expertise, and especially on a day like today when we got this big announcement from the Fed. Thank you for coming on.
Thanks, Michael.